Well, good morning, everybody. Once again, we have the bases covered. We have Heather in Kelowna. We have our producer, Mike, in Toronto. We have Milo, who is, if you can, Heather, just tilt your head. Milo is a Bermudoodle, and we were just having a conversation off air that we have a Bermudoodle as well named Albert. And Albert is becoming very famous. Hasn't got too many leading roles in movies yet, but he's willing. But Heather, we've had an opportunity to work with Heather for a few years now. She is based in Kelowna, which is about a 3.5-hour drive from Vancouver. Beautiful, beautiful place, lakeside, beautiful lakes in the area. And if you've ever been to Kelowna, if you haven't been to Kelowna, you really do want to go for a holiday. It's a beautiful spot. But Heather, tell us more about yourself and your firm, Tax Junction.
Well, we're just a small little boutique firm. There's 2 employees and myself, and we concentrate just on personal taxes and just on cross-border personal tax. So clients that have U.S. tax needs, either U.S. citizens that have to file, or people with rental properties, or people that work in the U.S., or people that are expatriating from the U.S., something U.S. And then we'll also do the Canadian as long as we have some U.S. tax needs with the Canadian. Otherwise, we leave the Canadian stuff for just Canadian accountants. So just personal tax, no corporates, no trusts, no partnerships. We focus on one area so that we can be really good on that area, and that's what we do.
Now, I know that a lot of these great accountants have migrated from some of the larger firms. So what large firm did you start your career with before you came out on your own?
I started at Deloitte in Vancouver, which actually back then it was called Deloitte & Touche, but changed when I was there. So that's how I got into the sort of U.S. tax cross-border world. I left it for a little bit, moved abroad for a little bit, and then moved to Kelowna about 16 years ago now. Then I worked for 2 different firms in Kelowna, Chroma Kai and MNP, and both of those I was sort of kind of running the U.S. tax practice at each firm. So at one point I decided, hey, why don't I just do it myself?
Well, we love the entrepreneurial spirit, that's for sure. So
yeah,
good for you. And you get to juggle a life of family. And of course, once again, I'm going to bring up Milo in the background. He needs a lot of attention. So
yeah.
you've got the life thing figured out. And you did mention that this year you're going to be taking your family to Australia. So I'm sure that's going to be a lot of fun for you as well. So
yeah, there's some nice flexibility with, well, working for yourself and then working in this tax practice where we get very, very busy for 4 to 6 months of the year, but the other 4 to 6 months have a little bit more leeway to not work as hard and go on some trips and stuff.
Oh, good for you. Well, today, like I say, today's show is really going to be geared towards the expat, that American that moves up to Canada. And we're going to be covering 2 topics. We're going to be covering, we have this term out in the world, which is called an accidental American, people not realizing that they have a tax filing obligation. So we're going to get into that with Heather. And the second part of the podcast, we're going to be talking about when these Americans do move up to Canada, the first person they call is usually a U.S. cross-border accountant, and they tell Heather, I've got this 401k or this IRA, and this charming, really intelligent Canadian advisor is telling me that I should roll it into my RSP for maybe some good reasons, maybe some self-fulfilling concerns, but there is other options out there, and that's how Heather and I have got connected in the past. So the first thing we're going to talk about, and I'm going to make this blog available. I was giving Heather great compliments before we came on air. She wrote this blog about your American living in Canada and what are you going to do with your tax returns and how do you bring them up. So the first thing we do is Heather's, her blog is called Now Might Be the Perfect Time to Catch Up. So Heather, why is now the perfect time? Now this was written in 2022, I believe, this blog.
Yeah, no, it's fairly recent.
Okay. So
the now would have been better a couple months ago than the now, but it's still pretty good. Still pretty relevant.
So tell the American people out there, those expats living in Canada, or these accidental Americans not realizing that they had a filing obligation. But let's go into the details of why they need to catch up last year or even this year.
Well, U.S. is the only country in the world that taxes people based on their citizenship. It doesn't matter where you live. So if you're a citizen of the U.S., you are required to file a tax return every year reporting your worldwide income. You won't necessarily pay U.S. tax, especially if you're in a higher tax country like Canada, because there's foreign tax credits and there's some exemptions and different things. But technically, you should file a tax return every year if you're a U.S. citizen. That's bottom line. There are still some U.S. citizens out there that don't know that. There's probably some that do know and pretend not to know. And then there's a bunch that know and file every year, and some begrudgingly. And it is what it is. I didn't make the law. So, and I don't think it's changing anytime soon. You can choose to expatriate and get rid of your U.S. citizenship so that you don't have to do this anymore. But even if you do that, you have to be 5 years compliant in your taxes. So you can't get out of filing tax returns at least 5 years. So that's not new news. That's been around for a long, long time. And there's been a procedure called the streamline offshore procedure, something like that, where the IRS is giving you a way to get caught up without any penalties and fairly easily. And basically you file 3 years of tax returns, 6 years of this form called an FBAR, which is essentially telling the IRS or the US government about all your foreign financial accounts if you have more than $10,000 in aggregate. So you file 6 years of that, 3 years returns, and you have to sign this certification statement to explain why you were non-willful in your neglect to file. So basically you have to tell them, I didn't know I was supposed to file, I'm sorry, I'm filing now. You do all that, submit it all by paper, haven't seen any penalties come out of it, so they won't penalize you, and now you're up to date, even though you've only done 3 years, even though you might be 30 years. In compliance if you haven't filed all that time. So that's the streamline procedure. The reason you should do it now-ish isn't anything to do with, well, some people will say, oh, it's because maybe you're going to get caught soon because of FATCA or different things. But my reason is because 3 years ago in 2020, the US government gave out stimulus payments for COVID, basically, to help out, just like the Canadian government gave out money. But they gave it out to anybody that made less than $75,000 US, and it automatically was just a deposit in people's bank or a check in the mail. And it was based on anybody that had filed tax returns the year before. So as long as you'd been compliant, you would have just gotten this check in the mail. And it was, I believe, up to $1,800 in 2020 and up to $1,400 in 2021. And if I'm getting these years wrong, I apologize. But the premise is you got free money to help you through COVID, and it didn't matter if you lived in Canada. You just had to be a U.S. citizen, you had to have been filing tax returns, and your adjusted gross income had to be less than $75,000. I think if it was more, you could still get some money, but it would come down or whatever. So, but if you didn't get that check for whatever reason, maybe you hadn't filed a return or something, you could apply for what they called a recovery rebate on your tax return. So we would ask in those years we were preparing those returns, did you get the check? No, yes. And then we apply and put this recovery rebate on their tax return, and then they get a refund. So you still get the money, but now it's kind of comes as a refund on your return. So if you haven't filed, important thing though, you need to have had a Social Security before 2020 for this to work. But if you haven't filed in ever, or 10 years or 20 years or whatever, and you're under that threshold, then you can file now. You can file those 3 years returns and get those two refunds of $1,800 and $1,400. Following me so far?
I am. And you know what? I'm reading your blog, and the big thing that kind of worries a lot of people, this FBAR that has to be reported annually. And there's a $10,000 fine if you don't file it. Like, the people are, do you know of anybody who has been charged $10,000?
No. No, I've never seen it assessed. I just tell people there's a big penalty for not filing it. I've never seen it. But could you be the first one? Maybe. I've read a few things where people have been assessed penalties. Like, I think most of those people have, quite a bit of money and are purposely evading tax, and therefore they're getting dinged with the FBAR penalty. I have not seen like your average taxpayer, but it's still there. It's in the law, so it's a risk. Compared to the T1135, which is the Canadian equivalent of the FBAR, I have seen penalties go to regular taxpayers on that if you file that late. Serious.
So that process of filing out the FBAR is just trying to report the highest level of. Now, would this include your RSPs? Would be included in that?
Yeah.
Anything that's outside. So your IRAs and 401ks would not be included because that's within the United States, and they
so anything, I always say non-US, just to make people, because if you use the word foreign and people live in Canada, they think, wait a minute, this isn't foreign, this is Canadian. So I just say any non-US financial account you have, so bank, RSP, TFSA, regular investment account, all of it, you have to detail where it's being held, the account number, the address, and the highest balance in the year, and put it on this FBAR form. It's intrusive a little bit. People don't love it, but at the end of the day, I say, you know how many millions of these things they get? Like, they're not going to look that closely probably at yours. But I need to get back to that recovery rebate. The reason why right now is a good time to file, to get caught up, or at least to file your 2020 return. I really hope I'm getting the right year, 2021, 22, is because if you want that refund that's supposed to be in your 2020 return, you have to file within 3 years of the due date of 2021. Or sorry, of 2020. And the due date of 2020 was April 2021. So 3 years from that is coming up this April. So if you don't file by then, they may not give you that $1,800 refund. So that's why the timing right now is kind of special for filing late returns, whether you do it through the streamline or not. So occasionally I get clients that are younger, 20-somethings, and they were born in the US or whatever, and they haven't filed, but they also don't have enough money for FBAR status. So they don't need to do the streamlined submission, but they could still file these 3 years and get those refunds back and then get themselves compliant. So sometimes we do a few of those too.
Now, do you find that living in a town like Kelowna, is it being a real pocket for Americans living in Canada?
Oh, there's definitely, a handful every year that I see come in, and maybe even more that don't come to me. But I don't know if it's anything more than any other city in Canada. I always, I will have meetings or Zoom meetings with any client that I call them transition clients. So they're moving from one country to the other. It's sort of like a mandatory thing that I need to go through all their situation and tax implications. I like to do that before they even move. Sometimes they don't contact me before they move, so sometimes I don't do it until after they move. But I'm curious why. Like, oh, you're moving from Missouri. What made you move to Kelowna? Yeah. And some of them, I don't know, the reasons aren't even, I have dual citizenship. We've never lived in Canada, so I'm just going to try it. I don't know. And they just come up with it. It's interesting to me always, though.
Oh, it is. Now, do you have a checklist? Do you built your own checklist that you can make available to people that are viewing this or listening to this podcast? If they wanted that checklist, you can forward it off to us and we can get out, or is it just something mentally that what you go through?
Like a checklist for people moving here?
Exactly. Yes, exactly.
Yeah, not really. It's probably just in my head at the moment, but maybe someday I should write a blog.
I think you should. It'd be terrible if I gave out your phone number and okay, Heather doesn't have this checklist, but it is in her head. So give her a
Yeah.
call and she'll text it to you. Well, that's
I did make a
interesting.
checklist for people wanting to sell U.S. real estate, though, so I could give you that one if you want.
Oh, that's perfect. Yeah, no, I think that would be great because, I mean, we are seeing this. I know British Columbia is making it very difficult. Yes, you can move here, buy a principal residence, but if you're moving here from just, I want to have a home in Kelowna or a home in Vancouver, I know the BC government and the federal government is making it very difficult for foreign buyers to buy properties here. And even for British Columbians to have a place in Kelowna as a recreation place is now going to cost you a lot more because Lake Country and Burn and all Qualicum parks will have all been added to this list as of
Now
last
you
year.
can't make it an Airbnb even if you wanted to. So the world is changing, the real estate world.
And once again, I guess the politicians are trying to make homes affordable for so many people. And we just said, let the market figure that out. But maybe I'm being too much of a capitalist and I'm going to be.
I would say most of the people moving here that I talk to, one of the spouses is already Canadian, there's a dual, and that's kind of why they're coming to Canada. Occasionally, though, there's some couple that just, or a person that just decided, I'm going to live in Canada, and they're going through the hoops of getting permanent residency and everything. But usually there's one already that's dual, and then if you have one that's dual, then it makes it a bit easier for the spouse, I think. But it's for sure a lot of work. You know, I've had calls with clients and I explain whatever I'm explaining about, well, you know, about all the, if you have investments in the US, I'm always trying to push them to bring them to Canada and to move with someone like you or explain all the difficulties. And some people are like, oh, this is a lot of work. Like, and I was like, yeah, it's not easy to move countries. I mean, it's not supposed to be easy. So if you want easy, stay where you are, kind of thing is what I say. Because being a cross-border person, whether it's investments or work or real estate, it's not easy. It's not supposed to be.
Well, we were speaking to a family last night that you referred to us, Soyuz, and they came from Kansas City. Wonderful people. We had a nice conversation, and very, very interesting. She had ties, dual citizen had ties to the Okanagan, and her husband is just in that Kansas City area. And very interesting why people move to Canada. I mean, I get it. It's a beautiful, safe country more than anything. Yes, we pay more taxes than 100 countries put together, but it's still a pretty safe place. So most of the people find you just through either the Canadian accounting firms that don't do U.S. tax, or how do people find you?
I don't know. I try to stay hidden as much as I can.
Yeah,
I don't know if this is going to be helpful for that strategy.
Yeah.
Good question, though. I think other accountants refer me. I think financial advisors refer me. I think my clients refer me. I think people Google and find me. They find me somehow. And, we've grown quite a bit, very fast over 5 years or 8 years, I guess it is. And I've lost some employees along the way, and I have to be careful because I have 3 kids, I have a dog to walk, I have a life to live, so I can't just keep taking every client. So what we've done over the years is we've narrowed our focus, and we're a bit pickier, to be honest, on what we take. But we're doing that on purpose so that the ones we do take, we really have that expertise to help them, and we can have the time to give them, if that makes sense. Or if you spread yourself too much and you're taking on something that you haven't really done a lot of, it'll just eat up your time, kind of thing.
Well, that seems to be the common theme amongst people that are very good in this space, is that, and that it isn't based on arrogance, it's based on resources, and it's based on, we have to be very selective on who we work for, because it is one of those fields that you're not only dealing with Canadian tax, U.S. tax, Canadian immigration, U.S. immigration. So people that are working in this space that are good, sadly, we have to become very, very picky. And growing up in a small town and having parents that were a truck driver, mechanic, and a chambermaid, it's not arrogance about the money. It's really just about the people and those relationships you think are going to be a good relationship going forward. Now we're going to kind of shift gears, and this is something that I see a lot. An American moves up to Canada here. They have this opportunity to take their IRA and roll it into an RSP using a 60J rollover. And I always tell people that be careful, because I think it does work in some cases, but I think in a lot of cases, I think there's so much more planning to be done on the U.S. side if they leave that IRA there and work with a cross-border advisor. But I want to hear your opinion on what you're seeing, and when does it make sense and when does it not make sense to roll over your IRA to an RSP?
You know what? Even the word roll, I don't really like it. Because typically a roll, like if you roll your 401k to an IRA, that's a roll. That's a true roll, because it comes on a slip that says you move this from here to here, but it's not taxable, right? Or, in Canada, if you moved an RSP from RBC to your firm, that's a true roll, or a regular account, not even an RSP, an investment account, right? Those are real rolls. The term to say that you can take an IRA and put it into an RSP is not a roll, because you cannot do it without tax consequences. People think you can, because there's this special rule that the CRA allows you to make RSP room where RSP room didn't exist if it's coming from an IRA withdrawal. And that's where potentially you can do it kind of without taxes. But it's not as simple as it seems, because when you take the money out of the US, or when you take the distribution from a US perspective, there's no roll. IRS does not even care what you're doing with that money. To them, it's just taxable. So you have to pay US tax on the the IRA withdrawal. So there's problem number one. You want to roll 100,000, and you can have withholdings already, so 20%. So you're rolling 100,000, but actually only have $80,000 once you take it out to put into the RSP. So you're gonna have to figure out how to find that other $20,000 to top that up, because you won't have it, because it'll gone to withholdings for the IRS. So that's problem number one. Problem number two is you then have to pay tax on that 100,000. So let's just say the tax is 20,000. And then your Canadian return has the 100,000. It is also taxable, but then you can take the RSP with deduction off of it. So 100 in, 100 out. Now you have zero taxable in Canada, but you just paid $20,000 to the US. So that $20,000 in the US is the foreign tax credit in Canada, but if you didn't pay any tax in Canada, then you're not going to get a foreign tax credit. So if this is your situation and you have no other income, you just taken 100,000, you've paid $20,000 in US tax, you've taken 100,000, put it into your RSP in Canada, owe nothing. And 10 years from now, when you take that 100,000 out in Canada, you may pay another 30,000. So you've just paid double or more tax than you should have had you just left it where it was, or just taken it out but not put it in your RSP, not rolled it. So the only way the roll part can work is if you have other income in Canada enough to produce enough Canadian tax to absorb the foreign tax credit. The foreign tax credit stuff is complicated. It's what I do, but I know it's not the easiest thing to understand for everybody. So even the word absorb a foreign tax credit might not mean much to you, but basically you don't want tax you paid to the US to not be fully credited on your US return, on your Canadian return, because if it's not, then ultimately you're paying double tax someday. So in this situation, and I don't know what the numbers are, because for me to figure it out, I'd have to recreate the returns, but maybe you take 100,000 your IRA, maybe you need 200,000 of other Canadian income to be able to absorb that foreign tax credit enough. So it's not easy.
And here's the other thing. If you're 59 and a half years of age or younger, there's an additional 10% withheld as well. So you're going to have to come up with that difference, that $30,000.
There's a penalty tax, they call it. And so in Canada, you can take RSP income out whenever you want. We don't have that rule, but in the US, if you take money out early from a 401k or IRA, correct, right?
Yes.
Unless there's a few exceptions, but you pay a 10% penalty. Now, the 10% penalty could be bad. It might end up okay. It would be included in the foreign tax credit calculation, but the bottom line is it's not simple. It's not the role you think it is if you think of a 401k to IRA role. So that's the first problem with it. It's going to take quite a bit of planning to figure out, depending on how big your IRA is, it could take many years for it to be able to roll over, and that's years that you have to have other income. And usually people at that stage of life too, because often this comes around in whatever 60s or 50s, they don't have a whole bunch of other income because they're kind of retired by then, right? So there's this small sort of pocket of time that this might work. And at the end of the day, all this complicated stuff just to move to RSP, I'm always like, well, why do you even want to move it to an RSP? Like, what's the benefit here? So there's the odd person that they just want to simplify their life. They don't want something in the States. They maybe hate the States. They have their reasons for not wanting something in the States. And maybe then the hassle is worth it. But often clients just have an advisor that's suggesting that they move their money up to Canada and put an RSP so that advisor can manage it, which I get in some ways. Like, why wouldn't you want everything in one spot to, have someone, you only have to talk to one advisor. You don't have to think. For sure, simplicity. There's lots of great reasons to simplify. However, the great thing about an IRA is estate planning compared to an RSP. So an IRA, RSP, if you die, it can be left to your spouse. And it's not taxed until the spouse dies. But it cannot be left to children or grandchildren or nieces or nephews or anything like that. If you leave it to anyone that's not a spouse, it is fully taxable by your estate. So if you have $500,000 in an RSP and you leave it to your daughter, she's going to get $300,000 or something, whatever it ends up being once the tax comes out. If you have $500,000 in an IRA and you leave it to a daughter, it doesn't get fully taxed right away. It gets taxed over up to 10 years in the daughter's hands after. So ultimately, there'll be more after-tax cash to the beneficiary from an IRA than an RSP. So that's why I like them. And it's simpler just to leave something where it is versus trying to do this rolling thing. I can give you a couple of reasons why it's potentially okay to be an RSP. One is RSPs eventually become RIFs, and RIFs are splittable for pension splitting purposes, and that can be some tax savings, so that can be worth it. Is it worth all the effort to get there? I don't know. It's hard to know. Again, if you ran numbers, right?
Well, I've always said that, the value of dealing with a cross-border advisor, making sure that I think having one advisor makes sense, because if it's an American living in Canada, we know there's all kinds of other issues with non-registered assets, maybe PFIC, dealing with the debate around TFSAs, et cetera. But who knows? Maybe that American person might want to go home one day. And I know that you cannot roll an RSP into an IRA.
Yep, good point.
So that's, and like I say, I've always said, and with myself going back and forth to Maui and being on an E2 visa and really understanding the tax of the United States. And I always said that the American seems to be there's a lot more planning around the American side. I've had guests on the show that just say that Canada is cruel when it comes to taxation of people that are willing to work hard and take risk and build something for themselves. The tax system is not favorable for those people. But it brings up a very valuable point, is that, Canadian advisors, as charming and as smart as they are, I say that often, and there are some really good advisors out there. But when it comes to these U.S. Retirement accounts and trying to roll them in, I think they're looking after their interests. And clients are influenced by their advisors. They trust them. These are
Mm.
smart, charming people. And I think sometimes they just get the wrong advice because they're looking at it from one point of view. Canadian client advisors do not have to file U.S. tax returns themselves unless they are U.S. residents or U.S. citizens. So I believe that there's, as the public, through the podcast, I think people are getting to learn more and more opinions from people like yourself, that the question is why? Why do you need to? And this is what I've learned. I've never had one retired client complain about having a U.S. source of income in U.S. dollars, spending those U.S. dollars on Canadian soil. I haven't had anybody complain about it. It's a nice problem to have. Well, Heather, I really appreciate your show today, and I want to thank yourself, and I want to thank Milo. He seems like he kind of left you high. Oh, he's down by your feet, is he?
He's in the corner now.
Okay, he's not in his favorite chair. So
Come say. Come here, man. Come here. Come on.
There he is.
Can you see him?
Yeah.
Right?
See, our Brimberdoodle has a lot more gold in his face. Oh, there he is. Oh, he does have gold.
There he is.
Oh, there you are. Oh, good for you. Well, we are dog lovers, and when Milo went from his favorite,
Oh, there he is.
when he went from his favorite chair and he walked by, it was like a squirrel in the room. It really caught my attention, and I had no idea what you were talking about, or was I listening to you? But I really appreciate your time. Thank you for being a guest on our show. We love the job that you do for your clients. Your clients speak very highly of you when they do make their way over to us. So we've become big fans of the job that you're doing. And on that note, I always tell people the world is small. Be kind to all.